Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 2 of how to use the P/S ratio to find growth stocks. Limitations of the P/S ratio. The price-to-sales (P/S) ratio is a go-to tool for many investors. It's straightforward and can provide valuable insights, but it isn't without its flaws. Sometimes, this metric might miss the mark, leading to misleading conclusions. Let's explore why this happens and how the P/S stacks up against other valuation metrics. Non-applicable for certain businesses. While the P/S ratio has its advantages, it's not universally applicable. Certain business types or scenarios may not benefit much from this metric. Why? Because not all companies are created equal in terms of revenues. Highly leveraged companies. Businesses with significant debt may look appealing using the P/S ratio since it doesn't account for liabilities. This can paint an overly rosy picture of financial health. Real estate and banking. These industries often rely on assets and liabilities rather than straightforward sales figures. Profit margins and debt levels play a critical role in their evaluation, which the P/S ratio overlooks. Early-stage startups. Startups might have high P/S ratios due to low current sales, making this metric less meaningful. These companies are often valued on future growth potential, which the P/S ratio fails to capture. In these cases, relying solely on the P/S ratio could lead you astray, like trying to fit a square peg into a round hole. Comparison with other valuation metrics. The P/S ratio isn't the only player in the valuation game. Other metrics like the price-to-earnings (P/E) ratio and the price-to-book (P/B) ratio also offer valuable insights. But how do they differ? Price-to-earnings (P/E) ratio. Unlike the P/S ratio, the P/E ratio focuses on a company's profits. It's useful for measuring how much investors pay for each dollar of earnings. While the P/S ratio considers sales, it often misses nuances captured by P/E, especially in industries where profitability is key. Price-to-book (P/B) ratio. This metric compares a company's market value to its book value. For asset-heavy industries, P/B can be more insightful than P/S since it reflects the true value of underlying assets. It helps investors understand if they're getting value out of the company's tangible resources. Profit margins. The P/S ratio doesn't account for profit margins. Two companies could have similar P/S ratios but vastly different profitability. A company with slim margins might seem overvalued when seen through the same P/S lens as a competitor with higher margins. Relying solely on the P/S ratio is like wearing blinders. It gives part of the picture but not the full story. Consider a broader array of metrics to ensure a well-rounded investment strategy. After all, understanding a company's overall performance requires more than just peeking through one window. Practical applications of the P/S ratio. Understanding the price-to-sales (P/S ratio becomes vital when we consider its practical applications. Investors and analysts use this tool to make informed financial decisions. Let's explore 2 key areas where the P/S ratio can make a significant difference. Using P/S for investment decisions. For investors, the P/S ratio is like a magnifying glass. It helps them focus on companies that might present good value for money. Here's how they use it. Stock screening. Investors often start by examining the P/S ratio to quickly identify stocks worth a closer look. A lower ratio might suggest that a stock is undervalued compared to its peers. Growth prospects. Companies with a high P/S ratio might be in dynamic industries where revenue growth is expected to blossom. Investors who are willing to bet on future growth may find such stocks appealing. Risk assessment. A critical eye on the P/S ratio can help uncover potential risks. A high ratio without a strong growth outlook might indicate an overpriced stock, which could be risky. Ask yourself, would you prefer a discounted gem or a high potential growth story? The P/S ratio points you in the right direction. Engage with these aspects by asking direct questions about whether a current price truly reflects a company's sales potential. This approach can guide you through the maze of stock selection. P/S ratio in mergers and acquisitions. In the world of mergers and acquisitions, the P/S ratio serves as a pivotal compass. It helps guide companies as they assess potential targets. Here's how. Valuation comparison. Acquiring companies use the P/S ratio to compare potential targets. It allows them to assess whether they're paying a fair price relative to the target's sales. Synergy evaluation. Companies also consider how a target's P/S ratio might enhance their current portfolio. A favorable ratio can indicate synergy potential, where the combined sales could outweigh the acquisition price. Due diligence. During this stage, analysts scrutinize the P/S ratio alongside other metrics to ensure comprehensive evaluation. This thorough approach ensures that surprises don't derail the acquisition process. Consider M&A as a business marriage. The P/S ratio helps decide if the match is made in financial heaven or if it might lead to future friction. In these practical uses, the P/S ratio is more than just numbers. It's a tool that sheds light on investment and strategic decisions, helping investors and companies navigate with clarity and confidence. Case studies of P/S ratio analysis. Understanding the price to sales P/S ratio is vital for investors looking to evaluate a company's valuation based on its sales revenue. By exploring real-world examples, we can see how the P/S ratio has played a pivotal role in highlighting both successful and failed company investments. This section outlines case studies to demonstrate the practical application of the P/S ratio in investment analysis. Successful companies with low P/S ratios. A low P/S ratio can sometimes reveal overlooked investment opportunities. Consider these real-life instances where companies with lower ratios proved to be good investments. Apple Inc. in the early 2000s. At the turn of the century, Apple had a relatively low P/S ratio compared to its peers. Despite its struggles in the 1990s, those who recognized Apple's innovative potential, especially with the launch of the iPod in 2001, capitalized on its undervalued price. The stock's incredible growth over the next 2 decades exemplifies how a low P/S ratio can uncover great prospects. Amazon in the late 1990s. Early on, Amazon's P/S ratio was modest as the market was skeptical about its long-term viability. However, those who invested during these early years saw tremendous returns as the company's sales skyrocketed. The modest P/S ratio signaled that the stock was undervalued, paving the way for its transformation into a global e-commerce giant. Failed companies with high P/S ratios. Conversely, a high P/S ratio can sometimes signal excessive enthusiasm, which may not be sustainable. Here are examples of high P/S ratios leading to disappointing performance. Pets.com, 1999-2000. During the dot-com bubble, Pets.com had an astonishing P/S ratio. Investors were convinced of its high growth potential without substantive sales to back it up. The company quickly burned through capital and filed for bankruptcy within a year of its IPO, revealing the risks of buying into hype without real sales performance. Webvan, 1999-2001. Another dot-com era casualty. Webvan boasted a high P/S ratio driven by lofty sales projections rather than actual revenue. The company rapidly expanded without a solid sales foundation, leading to its swift downfall and illustrating the dangers of relying solely on anticipated growth. These case studies highlight the importance of analyzing P/S ratios in context. While a low ratio might uncover undervalued gems, a high ratio could hint at unsustainable exuberance. Investors should consider these lessons when leveraging the P/S ratio for financial decisions. Remember, a thorough analysis often involves looking beyond just a single metric. Conclusion. Understanding the price to sales P/S ratio is crucial for making savvy investment choices. This metric helps investors see how much they're paying for a company's sales, giving a clearer picture of stock value. If you're trying to find undervalued stocks, the P/S ratio is a tool you shouldn't ignore. It's versatile and beneficial, particularly when earnings aren't steady enough to rely on other metrics. Remember, a low P/S ratio can mean a stock is undervalued, while a high ratio could indicate high expectations and potential risks. Don't just glance at this ratio, use it to dig deeper into the company's story. Ask yourself if there's more than meets the eye. And as you incorporate this tool into your investment strategy, you'll likely find yourself making more informed and confident decisions. Whether you're new to investing or a seasoned expert, the P/S ratio deserves a spot in your toolkit. Ready to take the next step? Dive into comparing companies using the P/S ratio and see what new insights you discover. Curious about where your findings might lead you? Let's explore together. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.